Murugesan is an associate professor of finance, and he also heads the real estate research initiative at IIM Bangalore. With over 20 years of experience in academia in global financial services, he is also an industry professional, and he's got a PhD from the University of Southern California. He joined IIMB in September 2011, and prior to that, he was with the world's largest hedge fund, Bridgewater Associates. I'm sure we will be covering some history of that today in the session, should that make its way. He's also worked with Goldman Sachs Asset Management in New York, and he was a finance professor at the Olin School of Business at Washington University in St. Louis from 1998 to 2005. If we could all please just provide Professor with a warm welcome to our session today. Let me also introduce our speaker for today, Chirag Gupta. He's the founder and managing partner at 8X Ventures. He's made significant contributions in India, Singapore, the UAE, and Saudi Arabia. Over the last 15 years, he has held leadership positions at 500 Global, Kareem, McKinsey, PwC, and Korn Ferry. He started 8X Ventures in early 2022 because he felt that transformative innovations in Asia needed a significant push. Within a span of 12 months, 8X Ventures has been ranked amongst the top 10 deep tech VC firms and has been identified by global leaders as the VC firm to look out for. He also mentors multiple startups from IIT, Chennai, Kanpur, and Delhi. Can you please provide him with a warm welcome? Over to you, Prof. and Chirag. Welcome to IIMB.
Thank you, Samita.
Thank you, Samita. So, first of all, this session is for you guys. So my role is largely to facilitate the conversation and probably fill up the Slack. So let's make it as interactive as possible for you guys. So I'm going to play a couple of, okay, is that okay? All right. Fine. Yeah, so I just want to start by asking Chirag some macro questions, on the funding side, since our focus is on funding. Everybody is talking about funding getting dried up. What's happening in the US, what's happening in the rest of the world. Of course, India is one of the oddball out in this global markets, right? So what, from your vantage point, what are you seeing in terms of how funding is changing for startups like these ones? And what sort of players are going to be there for the next cycle? I mean, I'm sure there'll be some people who will leave the industry and some people will come in. So what's your take?
I think what's happening right now in terms of funding getting dried up is, I hate to say this, it's a slightly exaggerated situation right now. The situation is, I don't think is as bad as we commonly see on social media right now. So there is a lot of dry powder available with venture capital firms. And when I say dry powder, the venture capital firms are sitting on hard cash. And all the VCs have deployment pressure. Deployment pressure basically means that if you're sitting on cash and you don't invest in the startups, you have to either return the money to your limited partner, or you need to deploy the money in some other alternative assets. Investing in alternative assets cannot easily happen because you need to take approval from your limited partners. So the only option is you have to deploy or you need to return the money. So when we say the funding is drying up, yes, there is a little bit of caution. The due diligence timelines have gone longer. It is happening, but the funding has not dried up, first of all. But however, there is a clear trend. There are certain sectors where a lot of VCs have suddenly realized that it's a winner-takes-all sector, and you cannot have multiple players to be the winners, or multiple survivors or multiple winners. And in those sectors, yes, the funding is definitely drying up. And I hate to say this, EdTech is one of those sectors. In certain parts of FinTech is also like that. Certain parts of D2C and consumer tech are also like that. Certain parts of blockchain are also like that it's completely drying up because the realization is the winner is taking it all. And if you fund someone which is the remaining of the 1,000 players available in the market, then the likelihood is that you're going to burn cash, and you will not be able to justify to your own LPs that why did you do that? Why did you invest there? But if you talk about certain sectors, actually, the trends are quite opposite. If you talk about climate tech, for example, or clean tech, for example, the trends are quite visibly the opposite. And we were just talking outside about the EV space or the energy space. The trends are quite visibly the opposite. The amount of money right now available to invest in the climate space, clean tech space, or energy space has actually very visibly increased, and the number of transactions that are happening on those areas has definitely gone up. So yes, when we say funding has dried up, yes, it is. There is a change in the trend, and there are areas where funding has definitely dried up. But I would not say it's across the board, and I would not say that it's the funding is not going to happen. VCs cannot wait for too long, because then there is a pressure for them. What do you do with that money? If you are sitting on $1 billion, SoftBank is sitting on billions of dollars, Tiger is sitting on billions of dollars, what do you do? So that is the questions VCs are also trying to figure out right now.
So how many people in this room are looking for funding right now? Good. So let me ask you, so what's the sort of area that you are in, and what are you ready for a pitch, or you're still figuring it out?
We are into.
If you actually can use the mic. Because let's make this as interactive as you can.
Hello. Yeah. So we are basically electric moped manufacturers. We do serve, last mile delivery services are our clients, basically B2B fleet operators and consumers who are into delivery services. So we do very unique model manufacturing. What was the next question?
No, the question is, you're looking for funding, right?
Yeah.
So let me ask you, what is this funding for?
But it's basically for scaling. I mean, see, we have done our bootstrapping and we have demonstrated product. We have done some pilot sales. We understood the product. We understood what the client requirement is. What is the current vehicles what they're using, and how are we better, or how is our product better than their problems they are facing in the current solutions. So that identification we have done, and we have deployed few pilots in their own fleet, and now they have given a very good order which we're executing, and we don't want to buy any assets right now, so we have outsourced most of the manufacturing or fabrication work. And we do assembles at their own facility. So, but now we need funding for, for scaling, to have more control over the technology, or to have more control of the quality of the product, how the contract manufacturer are making. So this requires some also marketing, because once we start thousands of vehicles production, the word had to spread. It's not just, we cannot do it out by ourselves.
So let me pause you there. Again, I'm sure I'll ask others also later. So this is probably a typical startup that comes out of IMB's incubator, and I'm sure most of the other. We've already done a prototype, got a customer who's interested, got some technology working, and now you're ready to scale, right? And of course, marketing and everything. Now, if I believe the funding is tight, so let's assume funding is tight. I mean, of course, there is always money for the right startup. How would you assess somebody like him, or somebody with this sort of a profile, to say, okay, what am I looking for? I mean, is there a sort of a roadmap that the entrepreneur lays out that you say, this is good to be funded even in this environment, versus something which looks like a standard template in which I would have normally funded in a regular environment, but I don't think your plan is good enough for this environment. So what do you think?
For a business like this, there are three elements which typically becomes like a filtering conversation. The first is the product. So he talked about the product has some unique elements, and he was talking about there is a differential improvement between the next best alternative right now. Um, as a part of filtering criteria for most VCs, they would want to understand what exactly is that differential, and is that like a 10% improvement, 20% improvement, 10x improvement, 100x improvement. Um, Generally speaking, if you say the differential is like a temporary differential, actually it's not a massive differential. The most VCs, I will not say all, most VCs would love to hear if you say it's 10x better than the next available alternative right now, or something like that, some ridiculous like good differential. So that immediately catches attention. When you say it's better than that, it doesn't tell me anything. So that's the first element of it. Second element is the is your team element of it. The second criteria, if I or any of my fellow VCs would have been reviewing it, they will go into the founding team. That how much. So he talked about we have bootstrapped, we have already built a product. So then we'll spend a lot of time trying to understand how much do they really understand the industry, how much they have actually put the blood and sweat into that, and are they. There's a not so sexy thing which is called, is he getting better sleep than me or not? So which basically means that if I invest in you, are you taking a bigger risk on the business than me? If your risk is less than my risk, then I don't want to invest. That's a typical unsaid rule in the VC ecosystem. So when we look at the team, how much sacrifice have you made? Have you actually a lot of people don't even leave their jobs. They have side hustles, which I understand why it happens, but are you literally all in? Has the team gone all in? Has the team done market research? Has the team built friendships in the ecosystem? Has the team been part of the players or a part of the events or conversations where things are really moving? So that's a second conversation that comes in. And the third conversation comes in is the market. That is the market big enough or not? He talked about the product, which is a problem statement. And we talked about the person or the team. The third is the market part, where how big is the this can scale. So now when you talk about the three-wheeler segment, what I don't know is personally is how big is this segment? Are we trying to capture a market in Bangalore? Are we trying to capture a market in Karnataka? Are we trying to capture a pan-India market, or are we going to also replace tuk-tuk in Thailand, for example? What exactly we are trying to replace? That market clarity has to be there. So most of the time, these three become the initial filtering criteria. And once that is done, then we go into the technical review of all the other factors that can happen and what can potentially go wrong. Something which I was talking to Professor earlier was something which has, which I feel has become the talk of the VCs is sustainable competitive advantage. And I keep using this term, sustainable competitive advantage, because a lot of people have a competitive advantage. Right now, you do have a competitive advantage. Probably your product is 2x or 3x better than the next available solution. But can you sustain to make sure that your product will always be better? What exactly are you doing that you will have that competitive edge for them? That's if you can convince any of the venture capital or any of the investors, the conversation gets so much easier than saying anything else.
Yeah, actually, just follow up on that. There's a lot of research on the kind of projects that get funded in different environments. See, when funding is cheap and funding is plenty, every business model will be better. I mean, people will bet on any model, right? Because nobody knows who's the winner. The betting is cheap. But the moment the funding cycle gets tightened, and because these people also have to answer to their investors, right? I think people don't realize that VC is also like a startup. I mean, they are taking somebody's money and trying to make something out of it, right? So in that respect, you have to show value, which is significant value, not an incremental value. So I think that's very critical for you. Maybe somebody else who wants to pick up on this thread, anybody else who is looking for funding? Yeah. Can you just pass the mic on to him? Yeah.
Look, good evening. So I'm Ravi. I'm from Dhobiji. We are into laundry tech sector. So right now we are looking for funding. We started as a initial startup idea was only for the e-commerce for the laundry. But when we started giving orders, we started generating revenue for the e-commerce side. Then we faced the problem the quality issues which normally laundries has. So we have 19 partners right now onboarded on e-commerce platform. We are generating revenue from there, but we found out they are also facing the issue that they do not have any technical solutions to manage their laundry. So now we are into development of the SaaS-based product for the laundry. The e-commerce model is going on. We are trying to grow that model, but with the same time, we are trying to build this system. So you are talking about the advantage, competitive advantage. I think this is the one which we will have, because e-commerce will come, but at the back end, laundry will always need that SaaS-based software system. So for that, we are looking for the first round of investment, and so that's it.
Actually, just to follow up, Chirag, as a VC, how do you look at somebody who wants money for development of technology for some advantage versus somebody in this environment looking to scale an existing product by going to new markets or expanding their customer base and marketing and so on? So how do you look at the two? Because one is inherently a little bit more risky than the other.
So I'll answer your question first, and then I'll come to your question. When it comes to raising money for the purpose of technology development, it's actually very difficult to raise that kind of money. At the bare minimum, you must have a MVP, which is working, a minimum viable product, which is working. And if you don't even have that, raising money for that is extremely, extremely difficult. Versus scale, the money to scale or fix the product where you are 80-90% product done, the product features are already there, but it's some buggy product. You just need to fix some bugs, and then you want to scale. It's relatively way easier to raise money for that. Coming to one of the things that you said about raising the first round of capital right now, you are in a platform business, and whichever way we want to quote it, SaaS laundry, practically you are a platform operator. Unfortunately, the funding has dried up for the platform businesses right of late. And now when it comes to raising money for the tech development or some of those areas, interestingly, there are a lot of grants which have been, there are about 543 grants right now in India. And some of these grants do cater because you are actually helping SMEs businesses solve some real problems on the ground. So there are some grants available at this point that can help you build the product and perfect the product. At this stage where you stand right now, I'm sure there will be some VCs, but most of the VCs have become very cautious in a platform business where there is not sufficient traction, the product is not fully developed. And there's a reason for that. For the platform business, and this is a very complex business, the demand and supply side managing on both sides is a very complicated equation. And getting into the critical mass is very difficult. VCs have burnt a lot of fingers. There have been thousands of platforms that have been launched and closed in the last couple of years. So from that standpoint, before you go to any VC, you have to make sure that your tech is fully ready. And like Professor was saying, your tech must be almost 80-90% ready. MVP must be like good working. Take some grants if you can. There are people in Niti Aayog who are helping right now figure out the grants. And once you have traction on both sides, both the demand side and the supply side, that might be a better timing to actually start having a conversation. Right now, you can start talking to them just to warm them up, but it's going to be a very difficult conversation. So that's. I hope I'm wrong. I hope it's easier.
Again, this is just our thoughts. You might actually prove us wrong, but definitely you should connect with the NSR cell on the grant part. We do have access to these government grants, and we should be able to get you if you qualify. Yeah. So just coming back to this, right? So I'm not a major fan of VC. So I have to admit it, even though I've got a VC next to me. I think if you can bootstrap. I think it is a phenomenally a different approach And especially in this time, right, when you're talking about scale, I mean, if you're in a sustainable mode and looking for scale is okay. There are many people who are not even stable, but they're looking to scale already and they're looking at money. And so those people suffer big time in the hands of VCs. So just be careful why you're looking at money and at what stage you're looking for money. Okay, so now coming back again, any other thoughts for you guys?
Can I agree on that before we take a question on that? So I actually agree very strongly that bootstrapping is the way to be. And I say this because one of the realization has been there are many VCs, angel investors, family offices, and the power equation is almost always skewed towards the investor. And because the power is skewed towards the investor, a lot of times you actually end up losing the almost like 40-50% of your company for a very small amount of money. And then like 2 years down the line, you realize actually, what did I do?
No, actually, we had a couple of years back, we had a session with Karthik from Bloom. Karthik is one of our alumni. And so he actually worked out the math in front of the startups to say that, look, this is how we look at you when you come in. And then the maths, when he actually put down the math, it was daunting, you know. The expectations from the VCs on each one of you was quite daunting. So they will turn the heat on. So I think if you can survive as much as you can, then you would be in a better position to even bargain with them, you know, in a better situation to deal with them. Yeah.
Hi, good evening. Hi, Chirag. Hi, Professor Nikesh. My name is Nishant. I'm the co-founder of Settlers. We are a fintech slash renting asset renting company, completely into B2B. We have been incubated out of IMB and SRSL. We are basically a company which helps startups, other companies to opt from a capex to an opex model through asset renting. And on top of that, we are in raising money on the platform wherein investors or NBFCs can participate on the same thing, and then a democratization of alternative asset class platform that can be made. Speaking on the revenues and the traction, we are currently doing close to 200K per month MRR with an accrued revenue of up to 13 million USD. Currently, we just closed our pre-series A round of 1 million in the month of Jan. Currently working on our Series A, wherein we're planning to close around 3 mil. We were fortunate enough to represent Indian startup ecosystem at Indian Pavilion at Dubai Expo this year. Currently, we are in touch with a couple of VCs based out of Dubai and Singapore as well. We were, in fact, last month in Dubai. Few of the VCs are currently interested. And then again from Singapore also. I mean, I knew that.
What's your question?
Yeah, the thing is, how do you look at startups when the rage is on the valuation, the revenues, and at the end of the day, people would want to look at profitability? What is the line that you would like to draw between the profitability and the growth and the scalability?
Good question.
When you say profitability, I'll break it down profitability at 3 levels. One is a unit economics profitability, then is the operating profit, and then is the net profit. I'm just going to the basics of finance. So now I feel for the business you are in, first of all, congratulations. Actually, you raised an amazing round actually at the current time for the business you are in. Raising a round for that must have been extremely hard work. So hats off to you. You have done an incredible job. Now, I feel at least now all the VCs have a different point of view on this, and I can guarantee you if you put 5 VCs in a room that we will not agree with each other on this. However, some of the VCs that I interact with, they agree that the unit economics has to be positive. It cannot be negative. You must be breaking even at the operating profit level. or at least close to that. You cannot be crazy off at the operating profit level. However, at the net profit level, it's completely understandable if you're burning cash at the net profit level. So, does that answer your question?
Kind of. I mean, what stage? Do we need to completely focus on the growth wherein burning cash is fine? Letting go of the profitability that.
Burning cash at the unit economics is definitely not fine. But burning cash for everything else is still acceptable in the P&L. But if your unit economics is not working, I will strongly get worried about it.
Makes sense. Yeah, thanks.
Yeah, actually, the thing is burning cash, as he said, right, at the top line, if you're not making the margins at the top, you won't survive. I mean, no matter whether he gives money or somebody else gives money, you will not survive. But if you are at the bottom line struggling, but you're making enough the contribution, then you have to worry about where you're spending. So a lot of times we see people spending in marketing when they should not be spending in marketing, or somebody spending in technology when they should be spending in marketing. So these are fundamental things which I hope if you have the right VCs or right investors or on a right set of partners who will be able to advise. So I think so actually coming back to the profitability thing, right? So I'm just taking a sort of thing. Do you look at profitability in the same way across sectors, or do you give a little bit leeway to the current fashion? Suppose everybody is in EV. You're willing to give a little bit longer rope for EV guys because you think it's a competitive media versus EdTech, where nobody wants to invest in EdTech. So if somebody comes in with somewhat decent profitability, you still look down on it.
Actually, I love this question. I'll later on tell you why, but let me answer this question first. If it's a shallow tech business, i.e. something where it can be easily replicated for the sake of it, let's say in a couple of months, even if it's a great business, fintech, edtech, most of the fintech, edtech, consumer tech are shallow tech businesses. If it's a shallow tech businesses, and you're burning cash at all levels. Sorry, let me first rephrase your question before I go to and make sure that I fully understand your question. Your question is it across the sectors that burning cash is acceptable? Did I get it right?
Saying that we have seen investors look at certain sectors in a very fond way, right? I mean, when there is, and that's usually because you're following the herd. There's so many people wanting to get into EV space right now. So, like you said, clean tech,
yes,
or any of those things, right? So there you are willing to compromise a little bit on profitability versus in another sector, which is slightly in a different stage of funding cycle.
So now, I basically, I just want to make sure that I understood the question right. I got it right. So in the shallow tech is one of those businesses where if you're burning cash at the unit economics in the early stages, I'm very concerned. But it's okay to burn cash because most of the shallow techs, not all, are winner takes all kind of businesses. And in a winner takes all businesses, the faster you move, the better it is. Like something that you were describing earlier is a winner takes all business. And if he moves slow, unit economics has to work. But if he moves slow, someone else will come and capture the market. So in that case, actually, it's encouraged. I'll use the word encouraged very cautiously. Encouraged to burn cash, wipe out, and move so fast that no one can catch up. Then comes the deep tech business. In a deep tech business, even at a unit economics level, you're going to burn cash. Because in the deep tech space, typically for the first 2 to 5 years, you'll be losing cash left, right, and center. And that applies for the EV space as well. Depending on what part of EV, if you're building like an intellectual property, you will be burning so much cash in the beginning without even touching the top line. You're even before your product launch actually happens. Like what the gentleman was talking about in the EV business. I can imagine even before you actually ship out the products, you would have already spent so much money perfecting the product and making sure the product makes sense, and you're not putting someone's life in danger. In that case, you are actually just going blind with the hope that one day your unit economics will be so positive. It's like a pharma company. EV is literally like a pharma company that you are actually doing so much clinical research before you actually launch a product. And once you launch a product, and if it's defensible and there's a clear differentiator, you will recover all the cost. So typically the way the finances are looked at for a shallow tech and a deep tech is like if I were to review this gentleman versus this gentleman, I'll be probably reviewing it in a very, very different way.
All right. So one other thing that we have noticed, right, which is VCs say that, when I see a projections, like Nishant wants to put in a request for funding, he gives me a full financials. I assume that most of it is junk. So you have your own filter, discount rates, you sort of cut it off by 50%, 60%, whatever it is. How do you look at that? I mean, just walk me through my mental process. Like, how do you engage with the numbers that are thrown at you? How do you yourself validate that?
Almost always, those numbers are wrong. So, I know even we ask for projections. What are you expecting? But almost always, at least in our case, we ask for those projections to understand. Do you even understand what you're talking about? Do you understand how to scale this? Do you understand what is achievable, what is not achievable? Do you understand what is the implication of increasing your top line on other line items? Do you understand the dynamics of running the business or not? I see I think a lot of people will agree with me that projections just give us a sense that do you have a control on the business or not. It has less to do with your real projection or not. And most of the time we'll spend time with you understanding the top line for the next 1 year or the next 2 years. And when I say time to understand, what's your pipeline like? If you're saying that I'm going to make a revenue for $2 million in the next 2 years, let's understand who are you going to sell to? Do you have even customer names in mind, or you are so blank that you have no idea and you are throwing a random number that I'll be able to sell $2 million? And the funniest thing is sometimes, and I hope no one is doing that when I say this, a lot of times founders come back and say, the market is $100 billion market. I am expecting to capture only 1% of the market. So I will reach $1 billion in 2 years. That's a very top-down way of looking at it. And I will be surprised if any VC comes in and says, oh, wow, you're capturing 1% of the market, let's do it. So it's generally to understand how do you think, do you have clarity on how will you make money? Almost always we run our own numbers. After we speak to you, we try to understand what you're saying. We try to understand what is achievable or not. Almost always, for us at least, we'll build our own financial model that this is what you're saying. But however, based on his explanation and what he explained about his pipeline, this seems achievable number. This does not. Sometimes it actually turns out to be 50% cut, sometimes like 30% cut. It's almost always lower than what the founder is claiming to be. But it gives us a sense on how they're thinking.
So also to remember, right, most of the VC investments don't turn off well. So their numbers are also not great. No, but just coming back to the same thing, right? I think numbers are one part, and then there are all these soft things to look for. So if let's say 10 of these people in the audience today want to pitch to you, what are the things you look for beyond the numbers?
The same 3 things that we talked about. So we'll first talk about the product problem statement. Second thing we'll look for is the team, how strong is the team, and third thing we'll look for is the market, how big is the market we can actually build with that. Once these 3 filters are crossed, only then there will be any subsequent conversation. If we don't understand these 3 things, or we are not even convinced about these 3 things, then most of the VCs will not spend more time on that.
Can you talk more about what you look for the founding team? Like, what exactly are you looking for the team?
There are multiple aspects that we look for in the founding team. And there is no, unfortunately, like a checklist, I would say. we're looking for science in the founding. What will make the business successful? Do you have experience in this industry? Have you ever built a business before? If yes, was it successful or not? If you built a business before, was it in the same industry or not? If you ever did a job or an internship, did you ever work in this industry or a sector or a function to understand the space or not? What is the educational background of this team? Like when we were talking about the tech development for a SaaS platform, can you actually sit down and debug a platform yourself or not if you have to? Or are you fully reliant on your tech team to do that? Do you understand the different, if it, let's say it's a platform business, do you have relationship with the people in the demand side and the customer side? There's no checklist or a one size fits all on this, but some of these questions that come on the top of my mind that I would love to know, and if none of these things fit in, I would want to know, why are you the best person to actually do this business? Why not anyone else sitting here are not more qualified to do this business? But having said that, a lot of times the underdog founders actually prove VCs wrong. Like Elon Musk is one of those examples. He jumps from one venture to another, and he proves everyone wrong.
No, this is like cat interviews. We ask the same question. Why should we get you into IM? And we always get proved wrong. So.
And you rejected me, by the way, a couple of years back.
Sorry. People here are single founder firms. You got to find somebody. So maybe, do you have anything to tell? How do you look at single founder firms?
So I'll tell you one of the morning conversations. So I was sitting with a journalist from a magazine called Nikki Asia. He asked me about husband, wife, brother, sister, single founder, and he had literally like a list of different types of founders. So yes, single founders are generally questioned upon, and that's primarily because it's a very lonely journey. The entire startup is a very, very lonely journey. And when you're running alone as a single founder, more likely than not, you will have emotional breakdowns. There will be days you will not feel like actually opening a laptop, calling anyone. It's not leading to anyone. And that's when having another co-founder actually is really very helpful. Because they can lift you up sometimes and you can lift the other person sometimes. So yes, it's generally frowned upon, but I would not say it's a very, very completely negative thing. Actually, one of the questions you asked me separately earlier, the single women co-founder actually have more problems than single men founders. They are more frowned upon generally, because single women founders very often, unfortunately, a question that is asked is, if you get pregnant, if you get married and you go on a honeymoon, or if you decide to not work, and these are unfortunate realities of life, but they do come up. So I think you're still not in that bad position.
It's a trade-off, right? I mean, you have complete flexibility in what you do, but the flip side is the world does not look at you in a favorable way because of the key man risk, right? I mean, tomorrow something happens to you, then what happens to the business? But now coming back to the people with co-founders, how many of you have a founders agreement? Nishant is.
No, that's because he did a pre-series A.
Did in this slightly advanced.
We didn't have a founders agreement and we had gone through the issues.
Fantastic.
Yeah.
So can you share, without giving details, what sort of issues?
So
Because it's an absolute must for all of you guys who have more than one founder. You won't even realize it, even though you might be the best friends today. I think the world will change. Yeah, please share.
So, so he's my other co-founder. So we had two other co-founders, or as the founding partners. But they had to make a decision to move out of the startup. We didn't have the agreement. But yeah, we had a very, they're friends for the last 10, 12 years for sure. So it wasn't so easy for them to part. But yeah, just because we didn't have an agreement, so and they have a considerable amount of stake with them, and you cannot raise your investment without having that. You cannot have so much of silent partners in your startup before you go, like let us say even Series E, F, and all, right? So that was the issue, and yeah, there is a large gap that has got formed among us.
See, the thing is, we have noticed in the NSR cell that companies are completely shut down. Good companies got shut down because they didn't have a founders agreement. And one of the dissenting founders dragged the firm down. And nobody, no investor will touch you the moment you have this. So even though you may be the best buddies when you start the company, you may not be the best buddies when you go further down. So I think it is a good practice to put certain basic rules down. And especially when it comes to dilution, when it comes to exits, so that, I mean, there are a lot of standard templates we can help you with, but put something down. And that gives confidence to VCs that, you know, the team will not get into a sort of even though the people might be great, but if they don't work together, it's a bad investment.
Actually, can I confirm how many people here understand the founders agreement? So others don't know what is a founders agreement.
No, it's okay, but man, this is, you can be honest. Okay, good.
I'll just give a 1 minute summary, and you should definitely read about, and thank you for Professor for bringing it up. I'll give you a 1 minute summary of what is a founders agreement. Founders agreement is a prenuptial agreement with your co-founders. If you get into a divorce like what they had, what exactly will happen, and if it happens in year 1, year 2, year 3, which year it will happen, and what exactly, how will you separate your assets? It has a clear demarcation on that, and it's the most uncomfortable conversation you will ever have with your friends for 10 years or your childhood friends, that we are signing an agreement that if you leave, these are the implications you will have to live with. So, but as Professor said, if you don't have a founders agreement and you screw up at the early stage or the late stage, the companies get shut down. It's a very unfortunate. A lot of companies actually don't have a founders agreement.
I mean, not just they will shut down, but you will have difficulty raising money. Especially as he said, if you have silent founders, absolutely not in your cap table. You know, nobody will want that silent founder. They want to be bought out. And so coming back to the, I mean, any other questions you guys have? Yeah, please. So any mic for him so that people in the audience.
So we are currently bootstrapped, and more of a friends and family round that we have done, and we have quite a few folks in the cap table. And when we go for a VC funding, right? So before that, a brief background about Boxfile. I'm a CEO of Boxfile, and this is a platform for the chartered accountants. It's a fintech SaaS cloud platform for doing the audit on our platform. And now we are making it blockchain enabled. It is going to be a blockchain based audit, so that they can do their external audit, internal audit, and whatever, the financial audits. That can be a completely blockchain based audit, one of a kind that we are building. And so we have quite a few folks on the cap table at this point as part of the friends and family. When we go for a VC round, when we want to scale up, how do you guys see having quite a few folks in the cap table as part of friends and family round?
When you say quite a few, can you clarify what is quite a few here?
So we have around 8 folks at this point in time, including the founding team members.
So I'll tell you the issue of having, so 8 is, to be honest, is not too bad. I have seen a cap table with 400 friends and family. And so you are definitely not in a bad shape right now.
He doesn't have too many friends.
You don't have too many friends. But the issue of having, I'll tell you what is a realistic issue and why VCs get very conscious when you say, I have 850 people in the cap table. Because every time you have to sign a shareholder agreement in the subsequent round or any fundraise happens, you have to sign with all the shareholders who were involved, who are on the cap table. Now, if you have 8, it means that it takes 8 days to get the shareholders agreement signed, because you have to beg everyone, please read it, sign it. There's nothing wrong in that. If you have 20, it takes 20 days. If it's 100, it takes 100 days. I'm making it up right now. But generally, the more the number of the capital, and that's the reason VCs are a little bit conscious. But eight is
sort of a common ground or a new ground that I've seen is you guys get into an LLP and I have the LLP Investors.
Okay.
So you have one person, the LLP is sort of a separate entity on its own.
Entry and they have the
Correct.
MOUs
So
kind of.
you just decouple rather than put yourself all in the cap table of the company. You have one investor in the company, which is the LLP. The LLP has its own partners. So there you can do whatever you want. So therefore, something like that can be decoupled. Because see, what I have seen in other cases that, I mean, again, I'm talking from experience in NSR 7. See, what happens is that when you're in early stage, right, you really don't know the value of your firm. So the same amount, same dollar that somebody gives, you're willing to give equal share. And then let's say 5 people join together and you divide it up 20% each, right? But then 2 people carry the load from first stage to the second stage. And the 3 guys are sitting idle. But they all have equal share. So then you feel cheated because the value grows exponentially. And if you don't do this, so what happens in many cases I've seen, the silent partner becomes the dominant partner because they know they control the show. And in one of a very good product startup, medical product startup that I know, so it's got funding from the US private equity guys and all. The silent guy literally brought the company down because they didn't agree to any sort of strategic partnerships because they just felt like, we wanted to be equal partners. So I think be careful when you divide up easily the money at the beginning. And I think again, he's nodding, so he knows from experience. These things happen because at the beginning, you don't know whether you're going to survive or not. And then you just give liberally, shares. Yeah.
I've heard like that. How do you analyze or criticize rather like the percentage share between the founders? Is the 50-50 not a good number? You want something else that it should be demarcated better than 50-50, do you think?
See, I'll give you my thought and then Chirag can add in. See, I feel the share has to be linked to your contribution. If you are 50-50 equally contributing, and as he said, right, you have to be very clear what people bring to the table. It can't just be that, I'm your friend, I'm also, I bounced ideas with you sort of thing. There has to be clear demarcation. And I don't know, maybe your experience you can say is that if somebody stops working over time, that when you claw back some of the share, have you seen anything like that?
So actually, there's nothing wrong in going 50-50. And as long as there's a founders agreement and there's a clarity in the whole split. And as the professor said, that if you're bringing equal contribution. However, if you make a slight split like 51-49, it's a slightly better because then if there is a confusion or there's a disagreement, then how you will make the decision and who calls the shots. It just gets easier in that case. And for the same reasons, even when you grow, actually, they will make sure, or like when I say all the VCs will make sure for the board and the cap table, there is a clarity on who calls the shot on the board. And there will also be a clarity on the cap table, how much equity you should own. So there's nothing wrong in 50-50, but as long as you're very clear who calls the shot when there's a disagreement, because that's where the difficulty comes in.
Oh, well said. That's the real issue. Yeah.
I just wanted your version of how VCs actually make money. Because when you're getting into the VC, I would suspect that most of the investments you make are with people who are negative, even on the unit economics level. So getting in there, you're taking a big risk, obviously a lot of work, but what sort of dilution do you target for? What sort of multiple are you to exit at? And what is the time frame that at 8x?
There are multiple questions in this. So how much dilution that startups go for? At every round of fundraise, we recommend about 20% of the dilution. The maximum can go is up to 25%, or minimum is like 10%. So typically it ranges. But I think on an average, it's about 20% dilution that the startups are going for right now. It changes as the company grows a little bit, but that's a typical dilution. How VCs make money? For us and for most of the VC firms, we charge a management fee to our investors. So let's say if it's $100 million fund, we'll be charging. So it's called a 220 model. 220 model.
So sorry, not particularly about the model, but in a particular investment.
In a particular investment. So the only way we make money in an investment is getting an exit. So when I say exit, either it gets acquired or it gets an IPO or something like that. Until the ownership changes hand, we will not make money, because most of the agreement we don't want dividends. And the dividend income is basically because of tax issues. In fact, it's preferred not to go into the too much dividend conversations. So the only way most of the VCs will make money is selling our equity to someone else.
Yeah, actually, this is again something that Karthik from Bloom mentioned. If they invest in 100 firms, they expect 1 or 2 blockbusters. If they get 1 blockbuster, they'll be very happy. Blockbuster would be something like, some 20, 30, 40x. About 5 to 10, they get somewhat decent return, maybe 2x, 3x. Another 10 or 20, 10 or 15 would be where they get the capital back. The rest of them write off. So roughly that was the number that he threw out. I don't know whether you had a...
So there's a very interesting research by Oxford University, which I was reading quite recently. So they ran simulation on a lot of VC firm strategies on how many portfolio companies you should have before you start generating returns or profitable. So they came up with a sweet spot of 20 portfolio companies. If you invest in less than 20 companies, the likelihood of you losing money shoots up. So most of the companies should be aspiring. There are different models right now, but should be aspiring, according to Oxford University, should be aspiring for 20 companies. And if I talk in real life also, a lot of VCs aspire for anything from 10 to 50. Some VCs, I don't know personally about Bloom. Maybe they do 100 per fund. But
he was just given sort of a placeholder number, right?
Okay.
If they invest in 100 firms,
okay,
this is the sort of ratio they're looking for. But what he said was very interesting. He says, even though we write off majority of our startups, we make the life difficult for the 100. It's not like they just look the other way around, and because they don't know who's the blockbuster. So at the beginning of the race, they'll push everybody and see who's really going to be the horse. So I think it's a very interesting model. That's why I said we see more. In fact, he was very clear. It is not for everybody. If you are in a business where you cannot generate that kind of return, don't even think of VCs. They're going to make your life hard for the capital they bring to you.
And so if I may add, actually, there's a VC called Ivy Cap Ventures in IIT Bombay.
Yeah.
So they came up with this term dragon. So, and which actually everyone talks about it, but no one uses that, was using this term. So let's say if I'm invested in 10 or 20 companies, I want each one of them dragon. Now, dragon definition is it returns the entire fund. So if I was a fund of $100 million invested across 20 companies, let's say each one of them should be aspiring to give you $100 million. And what will happen in reality is that only 1 or 2 will give you that kind of returns. And as you rightly said, about 3 or 4 will give you 2x or some, and the others will fizzle out. If you have one dragon at the bare minimum, your investors are happy that they got the money back. Then everything else is like a advantage to them.
So I hope that answers your question. Yeah.
I have a question on like the follow-up on what you said. So after investing money, right, what kind of support the VC firms provide rather than just show me the growth, right? Because there's a saying like, we have to also look at the quality of money and the kind of VC firms that we need to look at, right? So what kind of support that VC firm provides in terms of helping the entity to grow and prosper, and then it is like mutual growth is what we are looking at.
I can bet you the entire industry can fight on this question and not lead to a conclusion, and I'll tell you why. There are multiple layers of question. First is, should we even help the founder or should we leave them alone? Because there are some VCs, and including some of the prominent names, I'm sure Professor will know, they will tell you if the founder is so good and if you poke your finger too much, he will end up screwing up. So you better leave them alone, and they will come back with call you after a year with some amazing news, and you'll be super happy. So, and then there are VCs who will say, come on, how can you leave them alone? You have to. So for the first layer of question is, should we even help them? The second layer of question is, if we are helping, should we be actively helping, or should, if let's say we decide to help, should we be actively helping just as a governance or a quarterly review, or should it be like a more of an fully active help? So then some VCs take a board seat, and some VCs will take a board observer seat if they want to do like a monthly or a quarterly kind of help. And some will do like they are available on a speed dial. Now, your question falls in the category that if they are available on speed dial, if I got your question right? Now, within that, there are different VCs that brings different value. Some will understand your product, or they will understand your industry, or they will understand your market. Or by virtue of them talking to multiple startups, they might have synergies with some other startups, or they will have access to other VCs, or they will have access to other some other incubation cells. So once they decide to, if their heart is that I'm going to help you out, there is no real standard answer to say how they're going to help you out. There are VCs, and there are cases even for us. We have gone all the way to really gone to the sales pitch with them. They were trying to sell a product to a government organization, and we first opened the door for them in the Delhi government, and we actually went with them in the sales pitch. We closed. We made sure that they get the order. Then we made sure that they get the cash for that order also, because getting money from the government is also a little bit of a hard work. So it can go all the way to that level, or it can be as extreme as the founder is too smart. He's already a Sheldon Cooper. If you poke finger, he's just gonna get distracted. So I don't think, unfortunately, I don't have a single answer unless Professor has one.
I would just spin it the other way around. What do you want from them? Right? I mean, in the sense, if you are very clear what you want from them, you should be able to articulate to them.
So it's more like, opening the door and helping, kind of helping scale.
As you make it clear to them, and as I said, if they have that connects, they will do that for you, because it is in their interest to make you succeed. So I think that's, so we are coming towards the end. Any other questions you guys have before? So we have three.
I have one question related to board of advisors. Like, you have mentors, right? So, like, one question is that how you see, as we see, how you see the what is the advantage if you see a startup, like same ideas, everything is same. One startup has a board of advisor, and one startup do not have any official board of advisor. And the second question is that, and should the startup give a share to the board of advisor? How they should like benefit their board of advisor, make them officially present on the board or any way? So
can we take all the questions before you answer? Yeah.
Yeah, my first question is similar. The second one is there are a lot of companies which start off with a mission and the core values. And when the investor or the VC comes in, there's always, that's what I've read online, that there is always a constant fight between the investor and the founders in regards to the values of the company, and also obviously cash. So cash is the final master, but how do you think in terms of the founders and the investors, how do you think this fine balance is? I mean, how do you think it managed?
Yeah.
So being a
a second year student, I want to understand the other side of the table. How do you select, or who are the preferred people in your team, your side of it?
Should I go
Yeah,
first,
please,
Professor?
please.
Okay. I'll go to your question about the board of advisors. Should you have one? Should you not have one? What does VCs prefer? So most VCs, including us, prefer that you have a structured board of advisors. And generally, for a smaller company at a seed stage, you don't need to have a very formal board meetings, but you need to have frequent meetings, have frequent conversations around that. Sorry, I should have muted it. There should be some formal structure around that. And if you now on a board, if it's a very small startup, probably it's a board of only 3 people, where 2 of the board members are your co-founders and 1 is representing the VC. That is only just to make sure for the VC to make sure that you are actually running in the right direction, and it gets the opportunity now. So that's one part of it. The other aspect of the question was having those external advisors where mentors, where you pay equity. You can bring mentors, but just be cautious of putting them on a board. Having mentors and having people on the board are 2 very different things. And I don't always recommend having mentors on the board seat. On the mentors, yes, you should and you can and you should give equity depending on who is your mentor, but there has to be like a vesting schedule. You cannot say that, and there has to be a very clear articulation of the expectations with the mentors. More often than not, we do not see mentors agreement. Just like founders agreement is very important, mentors agreement is equally important, because if you're giving 2% equity in the company, and after the guy signed up the agreement, he says, I'm too busy to talk to you because you're too small, you actually lost 2% of equity for what? So there has to be a clear expectation investing schedule.
Yeah, I would say don't give to mentors unless you're forced to for some reason. The second thing on the board is don't take in people who are quite different in their risk aversion. Because many of the people who are there in the mentor pool are all corporate guys who have been in a senior positions. Their outlook on risk and the market is totally different to the current entrepreneurs. So they may actually be dragging you down. So be careful about who you want to bring as mentor. You can sound them out, because again, at different stages of the venture, you might need different sets of people. Like if you get into a slightly bigger stage, then you need systems and process. So at that time, the corporate guys will be perfect. They will help you transition to that sort of thing. Otherwise, they will drag you. Be careful. Yeah. So his point of founders versus investor conflicts.
So if I clearly understood your question, and let me just rephrase your question first. Your question was, if you come up with a vision and mission of your product and the company, and the investors don't fully agree, should you tweak it or not? While you're pitching or after you're pitched and they have come on board? Is that the right question?
Yeah, something like that. Because once we get the funding, in the long run, let's say if the company is not doing very well or we're not meeting the targets, right? Who plays a more important role in how do we negotiate those issues? Because for the investor, the cash and the returns are right. And for the founders, they would have started with a particular core values or a mission. And some of them may not want to deviate completely because the investors' pressure.
So first of all, if you are running a startup, irrespective of what investor says, you are in the driving seat. You should be in the driving seat, and you should be able to hold your ground to defend why you are saying this will happen and what will happen. It's your job to convince to the investor and to everyone else why it should be the case. That's first. Second is when you sign up with the investor, and that's where actually Professor was making a comment about understanding and having an open conversation with the investors when we were answering to the question here. It's very important that you articulate and have a very open conversation with the investors to know each other personally. Getting investment from someone is as good as getting married. You will get into fights, you will laugh together, you will fight together, it will happen, it's bound to happen. But as long as you can explain, defend yourself, and maintain a relationship with your spouse, that actually solves it. And when you fight, like when you in a married life, I'm assuming you're younger to me, in a married life, you never go to bed without solving a dispute. So it's the same with the investors. When the moment you see something is starting, your first thing you do is you solve that, you close that argument and explain why, understand each other, talk openly. But you are in the driving seat.
Actually, I have a slight different take on this. The moment you take money from somebody, you got things change. Okay, so don't think that it's your firm anymore. Okay, so I think you have to be practical. It all depends on who has the higher shareholding and who can actually drive the agenda. Okay, so if you are a soft guy, even though you might be holding 80% against a VC, they make all the shots. So I think what would be the right answer is, what is your belief in how the firm should be run? And if you should figure out how to convince that VC.
That should be done upfront.
It has to be a continuous process. It's not like one time you do it and then walk away. In fact, keeping them updated is part of your job. Keeping them in the loop, keeping them how you're thinking about it, how you're moving forward, it's absolutely part of your job. And if you don't do that, as you said, they are busy with so many other investments, right? So then they may come in and with a completely different take. So in my mind, the moment you take outside money, it's like lenders, money lenders. They're not going to go away. Okay, so be prepared for that.
I can see, Professor, why you hate VCs.
No, I'm just saying, see, we have seen so many startups struggle with VCs, and many of them also have done very well. I think it's as you said perfectly, it's a marriage, right? It's a right fit. But I think many people, they take VC when they're not ready. But they're not ready, not from a business point of view. They're not ready mentally to accept somebody else on the table. You got to be prepared for that. Okay, so I think you should talk to people like him who has done few rounds, how the whole business works. Because VC business model itself predicates, particular response from them, how they will treat you. And your question on what are you looking for, right? I mean,
Your team, like how do you select and what is it?
Basically, he's looking for a job, right?
So generally, it's actually very difficult to articulate what kind of person fits in. And I'm quite confident all VCs have a very different approach. For us, particularly, we look for people who can break down the problem and who can look into my eye and constantly tell me you are wrong. And the more you tell me that you are wrong, and with a solid rationale, and not just like coming to me randomly and saying you're wrong, like we hired an intern from a college called IMT Ghaziabad. He had not the most spectacular credentials, but good credentials. And that was not the college that we look out for, but someone recommended that candidate to us, that you should interview this guy. We brought him as an intern, and 1 week into our investment conversation, and so he was allowed to sit into a meeting room where we were discussing a startup investment, and he politely asked for like 5 minutes to present his point of view. And he actually, with a lot of data and conviction, proved us wrong constantly. And literally, like for 2 months, it was like my life was hell, because every time I start talking to him, he'll spend all night trying to prove me wrong, which is something like a spectacular skill, because all VCs are biased. We have our own successes in the past, and we are just trying to replicate a new success by doing the same thing again, over and over again. So we need someone who can tell us that what you're doing is wrong, or have an objective argument with us, like a sensible argument with us on a point. Constantly can read and absorb lots and lots of information. One of the things that people very massively underestimate, the amount of reading that goes into the VC jobs. Every pitch that we read, of course, it takes a long time to prepare a pitch, but the moment you read a pitch, you have to spend time understanding the industry. You have to spend time understanding who else is doing it, why this can be a success, why this can be a failure, and requires a lot of literature research. A lot of VCs are generally sleepless because overnight they are doing a lot of reading. In the morning they want to meet other people, but after, like, if I have talked about his business or his business, I know if I have the pitch, I'm going to spend my night reading about their businesses. So if you can actively read and justify your ground by objectively disagreeing with people, that's what I think most of the VCs will look out for.
All right.
Is that in line with what the hiring has happened? By the way, just to tell you something interesting, I tried hiring for interns, and it's a good, amazing job at IIM Bangalore. We tried hiring interns this year from first year. We were scheduled to interview at day 1, and the batch got placed at day 0, and we got a notification that nobody's available now.
So we have a couple of students over there. I know you all you guys have got a job already, right?
Yeah.
Yeah. Sorry, unfortunately.
I'm appearing.
No, but I think you gave a fantastic answer. I think it's a combination of communication and analytical skills. I think, I mean, we try our best to prepare them for that. So hopefully we'll get it. One last question. I think we are already 10 minutes off the clock. Yeah.
So what is the true definition of deep tech? Because, like, say, it's sector agnostic, because people are calling software as a deep tech, maybe blockchain as deep tech. Some startups like, or EV are also deep tech. So what is the true definition of deep tech?
I'll give you NASSCOM answer. I'll give you the NASSCOM definition, okay? And every organization has their own definition, but since we are in India, I'll give you NASSCOM definition. NASSCOM divides all technology startups in 3 horizons: Horizon 1, 2, 3. I'm assuming you might have heard of that. So Horizon 1 is that where you have a clear visibility, and typically it's like a year. The solution will be deployed, and it can be built, and you have a clear visibility on how this will be built. That's Horizon 1. Horizon 2 is something which you have a vague idea on how this will be built, and you have to do a lot of R&D on that. And it takes anything from 2 years to roughly 5 years. And Horizon 3 is something like sending rockets to Mars. So now deep tech, generally, not always, by NASSCOM is defined by the Horizon 2 is the deep tech. So Horizon 1 is a shallow tech, Horizon 2 is deep tech, Horizon 3 is a lab tech, because you're working on it in the lab.
Horizon 3 is Musk tech. He can do it.
It's not the true sector. Maybe it's about the time frame, right? Like 2 years to 5 years, you are building a product. So it could be a EV, it could be a software product, it could be anything.
It can be anything, but that in the deep tech, the technology has to be almost always proprietary, and has to be something which is not easy to replicate. And I wanted to say intellectual property, but the realization is intellectual property in India, for the lack of better word, it can be replicated. So whatever you're building has to be proprietary and cannot be so easy to replicate.
Hey, thank you guys, and thanks NSR Cell for a wonderful boot camp. Thanks Chirag for coming and
thank you, Professor.
I hope you guys had a good time. He's always available. So if you have any other questions, shoot. All right. Thank you. Hey, thank you. Thank you guys. Thanks for staying extra time.
I'm here for a while in case anyone have a quick chat. You find it great.
I think